This is lecture 8, cash. Okay, I'm presuming that most people listening have or have had a bank account at some point in the past. If not, then you probably will in the future. And certainly any business that you work for will have a bank account. Now, when you have that bank account, you receive a bank statement, usually once a month. Okay. Now, sometimes that statement can come as a paper statement in the mail. I know that's very old school. You can also receive it electronically online, right? But regardless, the bank will send you a statement showing all of your activity in the bank account for that month. Now, when you get that bank statement, you're supposed to read it. Most people will read it. They will take a look at it. Now, what you're then supposed to do is you're supposed to take a look at the activity on that bank statement and compare it against your own personal cash records. I know most people think about that and they're like, what? I'm supposed to do that? Shouldn't I just trust that the bank's information is all correct? Well, banks are so trustworthy, right? But whether or not you think they're trustworthy, banks do make mistakes. Everyone makes mistakes. You could have made a mistake. So you are actually supposed to check that bank statement against your own personal cash records. Now, back in the olden days when everything was manual, right, people would actually keep their cash records in their checkbooks, in their check registers. So when they wrote a check for a payment or when they made a deposit, they would keep track of that in their check register. And then that would be what they would compare against what the bank statement said. And that's why for individual people, we call this balancing the checkbook. You might have heard that term before. Most people do not do it, but it is something that people should do. More importantly, companies have to do this. There is not really a choice for a company because with a company, it's very, very important that you understand what is in the cash account and what has gone through and what is valid. So if there are any mistakes, we need to catch things right away. So it's super important that companies have to compare the bank statement to their cash records every single month. Now, the good news is that while for an individual, you might have some scribbles, hey, here's my cash record. For a company, we have the cash T account, right? The company is definitely keeping track of their cash. So we have a lot better resource to use to compare against the bank statement. Now, here's the interesting part. Even if you have been keeping your cash records meticulously, even if everything in them is correct, the chances are very, very good that your cash records in the T account do not match the records on the bank statement. Now, why would that be the case, right? If everybody's doing everything correctly, why wouldn't our cash records in our account, in our accounting records, match the cash records that the bank has for the same bank account? The answer is timing. There are many transactions that hit the company and the bank at different times. And because they hit at different times, they are recorded at different times. So you could easily see something that the company has recorded that's not in the bank statement, or something that the bank has recorded that's not in the company's records. And this is the other big reason to compare the bank statement and the cash records is to catch all of these things with the different timing and then make sure those things get recorded. All right, so let's think about these things. What kind of stuff is going to be hitting the bank and the company at different times? Well, the most common reason for these differences is something called outstanding checks or outstanding payments. Okay. The traditional term is outstanding checks. I know most people don't write physical checks anymore. But companies still do, right? Companies still send out paper checks a lot of the time. And regardless, you could just think of this as outstanding payments, regardless of the payment method. Okay? So think back to the old school way of writing a check. Let's say that I get a utility bill in the mail and I want to pay it with a check in the mail. So I write the check. Then I have to put the check in the envelope and I have to mail that envelope to the utility company. Then the utility company has to receive the envelope. They have to open it up in their mailroom. Then they send it to the correct department. Then they apply the payment to my account. And then they go to the bank and try to cash my check. All right, how long does that take from the time that I write my check and therefore I update my cash records that, hey, I made a payment? How long is it between that moment and the moment that the utility company cashes my check and the money actually comes out of my bank account? Well, it's got to be at least a week, right? Because the whole thing has to be mailed and it's got to process through the other company. So we have a week's time period in there where I have taken the money out of my account because I've written the check and I've recorded the payment, but the bank has no idea that I've made that payment because it hasn't been processed yet. Right? So that's what outstanding checks represents, or outstanding payments. Right? It is payments that have been processed by the company. Well, let's say made by the company. Let's make it a little more clear. That have not yet been processed by the bank. Now, there's a similar concept that we can have with deposits, right? And that's called deposits in transit. So deposits in transit, oh goodness, my formatting is just all off today. So let's change that down here. Clearly, I'm destined not to have this work. There we go. Okay. So deposits in transit are the same thing, but with deposits. So in other words, the company has made a deposit with the bank, but it hasn't been processed. Now, this happens more with actual deposits. So for example, if you've ever made a deposit and it's been put on hold, then you have a deposit in transit. Right? So for example, I come from Canada. My parents still live in Canada. So every so often they will send a check to my kids for their birthday or for Christmas or something like that. So, they get a check for $10 or $20 or something like this. Now, I go to the bank to deposit that check, but of course it's drawn on a foreign bank. Okay? So because of that, I could be a terrorist, right? So the law says if there's a check from a foreign bank, they have to put a hold on it. And it's usually a 10-day hold. So it doesn't matter how small the amount is, right? It doesn't matter how many times I come in and do this with checks from the same people, right? They have to put a hold on it. That's the law. So I go in, I deposit the check, hold, 10 days. So for 10 days, I have a deposit in transit. I know I've made the deposit. I know I've given the check to the bank, but the bank hasn't processed it yet, and they haven't put it in my account. Okay? This can also happen with things like deposits at ATMs. Right? Back when ATMs were new technology, people very quickly developed a scam where they would put blank paper in the ATM. So you tell the ATM, I'm depositing a check with $1,000. And then the ATM would say, okay, put your check in an envelope and put it in the machine. And they'd put blank paper in the envelope instead of a real check. And then they'd say, okay, now that I have $1,000 in my bank account, I want to withdraw $980. All right. Obviously, that wasn't something that banks liked very much. So very quickly, they said, hey, if you're going to make a deposit at an ATM, then it's not going to hit your account right away and you can't make withdrawals on it. So again, another hold, right? So if you make a deposit at an ATM, let's say you get your paycheck and you deposit it Friday night, right? And then takes until Monday for the technician to come to the ATM, right, to pull all that out. And then they have to take that to the bank, and then they have to have someone open the envelope, verify it, process it, right? That takes a few days. That's why, of course, electronic depositing now, where you just take a picture, that's why that's so much more popular, because it happens much more quickly. But if you're doing it with paper payments, paper checks, you still have that processing time. So, just another example of how things can take a while. It can even happen with cash deposits. Okay? Let's say that you run a business that operates late at night. So let's say all the restrictions are lifted and you own a bar or a nightclub, and you're operating that nightclub until 2 or 3 in the morning. All right, now for some reason I don't understand, people like electronic payments everywhere, but somehow at bars, people still pay a lot of cash. Um, so bars, nightclubs, they tend to collect a lot of cash. Now, they don't want to keep that cash around overnight, because if they do, then they become a target for thieves. So it's very typical that what they'll do is they'll take the cash after the place closes for the night, they'll count it, they'll write out a deposit slip, and they'll put it in this special bag that the bank gives them. And they'll take that bag and they'll physically walk to the bank in the middle of the night, and they'll use what's called the night deposit box. You might have even seen this on some banks as you've walked by. Kind of looks like a mail slot, like a handle, and you can drop something in. So that is for night deposits. So they will physically drop the cash into this slot, and then it goes to a secure place in the bank. So they've made the deposit, the money is safe, right? It's off their premises in case somebody breaks in and they're trying to look for the cash. But of course, just because it's in the bank doesn't mean it's processed, right? If I'm opening my bar on Friday night and then I make that deposit by dropping the money in the night deposit box early on Saturday morning, well, it's going to take until Monday before employees come back into the bank and open up that box and then start taking a look through the deposits. They'll have to open up my bag, count through my cash, verify the amount, and then process it to me. So it might take, again, a few days for that to process, even though I've made the deposit. Okay. So there are situations, most common is just the generic, we're putting a hold on the deposit, but there are other reasons why deposits could be delayed. So that's what's happening here. So a deposit in transit is when the company makes a deposit, but it has not yet been processed by the bank. Okay. Now, these are things where the company has done stuff and the bank is later to process it. There are a number of things where the bank processes stuff first and then the company learns about it after the fact. For example, one of the things that everyone hates to see on their bank statement is service charges or fees, right? Nobody wants to see that. But that's how the banks make their money, right? Was with all these service charges and their fees. So what happens, right? You do something that incurs this charge, that incurs this service fee, and the bank processes it immediately, right? You immediately have that fee. Often you don't even know that you've incurred a service fee, and you'll just see it when you get your bank statement, or you might know that you've incurred the fee, right? I used an ATM that was out of network, but you don't know how much that fee is. So when you get the bank statement, you have, oh, yep, there are those fees, and you haven't recorded them, right? So that could easily be a difference between the bank's records and yours. Now, not all surprises on the bank statement are bad, right? There's also the possibility of interest. Now, interest used to be a really big thing because we used to actually have real interest rates. And you'd have a savings account and you'd be earning money on that savings account every single month. Interest rates were going up and finally starting to go up again with this whole crisis, the interest rates are pretty much falling again. So right now, there isn't really a whole lot of interest on bank accounts. Hopefully that will come back in the future. But, if you have some kind of bank account where you're earning interest, then that interest is going to show up on your bank statement, and then the company would have to record it. So typically, if there is interest earned on the account, the bank is recording that first. Now, another possibility is one that's definitely not so pleasant. That's the possibility of NSF checks, okay, or NSF payments. NSF stands for not sufficient funds. That is the bank term for these things. What lay people like you and I call them, we call them bounced checks or bounced payments. So, let's say that you receive a check from somebody, right? And you take that check to the bank and you deposit it in good faith. Okay? Now, a couple of days later, the bank contacts you and says, hey, that check you deposited, it was NSF. It was not sufficient funds. The person who wrote the check did not have enough money in their bank account to cover the payment. All right, so that is an NSF check. Now, the problem is you made the deposit. You did it in good faith. You did the right thing. But who gets the service charge? You do, because you were the one they had to process this check that didn't work. I've always thought that was kind of unfair, but that's the way banks do it, right? They like to go after anybody they can. So if you try to deposit one of these checks, you're going to pay a service fee, even if you didn't know that it didn't have enough money. Now, for a business, they never, ever, ever, ever want to write one of these checks or make a bad payment. That's because their entire reputation hangs on every single payment. Let's say a business made a payment to you and that payment bounced. What would you think of the business? At the very least, you'd think that they were sloppy, right? How can they do that? How can they make a mistake like that? Or you might start wondering, hey, do they have enough money to make this payment, right? Can they even do it? Maybe they're in financial trouble. Whatever the case, the company's reputation is suffering significantly from a single bad payment. So companies will do whatever they can to avoid making bounced payments. They do not want to make payments like this. And you'll only see a company doing this if they're in real financial trouble. So we're talking about healthy companies in this class. Companies generally will not make these bad payments, but they may very well receive bad payments from their customers. And that's why I put the word deposits here. Generally for a company, when you're talking about bad checks or bad payments, you're talking about a customer making a bad payment to you. You're the one who gets stuck with the check that's going to bounce when you try to cash it. So we're looking at this from that point of view. So obviously we've got a timing difference here, right? You make the deposit, you put that in your records, hey, I have more money. And then the bank is the first one to learn, no, you don't have that money because the payment didn't go through. And then there's a little bit of a delay between the bank finding that out and informing you. So that can be a timing difference there where you think you've got this money, but no, actually it was NSF, it bounced. Okay, another thing that processes through the bank before it goes through the company is EFTs. EFT is a banking term. It means electronic funds transactions. Okay? So essentially it means electronic payments and deposits. Any kind of auto payment, any kind of debit card payment, anything that goes through electronically. Now, electronic payments are great, right? Because they get processed right away. We know that. But sometimes we forget that we made them. Sometimes you sign up for auto pay, right? Or direct deposit, right? If you've ever had a job and you've had direct deposit with your paycheck, right? Sometimes you sign up for these automatic payments or your automatic pay deposits, Or sometimes you do something online and you say, hey, I want to make this electronic payment on this future date, and you forget about it. Or sometimes you have these automatic payments and such, and they're different amounts every single month, right? Maybe I have direct deposit with my paycheck, but I work on commission. So every month my deposit is different. Or I have an hourly job and I work a different number of hours every month. So my pay is different every time I get a deposit. Maybe I have automatic payments for my electricity bill. Well, my electricity bill is different every month based on how much I used. So I don't even necessarily know how much this payment is going to be. Typically what happens with these kinds of payments, even the automatic payments, is, somebody will get their bank statement and they'll see the automatic payment going through and they'll say, oh, that's right. I got paid for my job and oh yeah, I had to pay the electric company. I had to pay for my car insurance. I had to pay for, whatever else you have those automatic payments set up for. So often what'll happen is that'll process. Regardless, the bank always knows about electronic transactions first. Even if it's you using a debit card at the grocery store, right? Use a debit card to make payments. So hey, I'm putting in my debit card. I understand that. But that payment is not complete until the bank processes it. And you get that little notice on the screen that says, yes, the payment was approved. Right? So the bank always knows first because the bank is the one that has to process and approve the payment or the deposit. Even if you know a second later because you're sitting there with your debit card, the bank always knows first. And so if it's not something like a debit card, if it's something that happened, off screen, then the bank may have recorded that and you may not have done. So that's where a timing difference can occur. All right, lastly, there's always the possibility, and this is on both sides, of errors, right? It's possible that there may be a mistake on the bank statement, that there may be a problem. So it's also possible there's a problem with your records, that you made a mistake, right? It happens. People make mistakes. So it's important to compare the bank statement and your cash records so that you can go through all of these things that are legitimate but have to be updated. So you get these things updated, and then anything else left is going to be some kind of error or potentially fraud. It's also possible that somebody may be taking money intentionally, and that can also cause discrepancies in your cash record. So it's important to compare everything, both to make sure everything's updated and to see if there are any errors or fraud. Now, the document that we use to compare the cash records and the bank statement is called a bank reconciliation. So the bank reconciliation will explain the differences between the cash T account and the bank statement, right? Typically, these are the differences. So it'll explain those differences, and it'll calculate the correct amount of cash that the company actually has. Now, I'm sure I've been very, very confusing. So what we're going to do is we're going to go through an example, and I'll show you how we prepare a bank reconciliation. Okay, so let's take a look here at example 1. A company has a cash balance of $1,200 at December 31st. Their December 31st bank statement shows a balance of $742. Right? So this is what they have in their cash T account. The bank statement says this. Right? Now, why is there a difference between them? Well, these following differences exist. We know there are bank service charges. There's an NSF, a bounced payment from a customer. There are outstanding checks. We made an electronic insurance payment, and there are deposits in transit. In addition, the company accidentally recorded a check written to the electric company for $59 as debit utilities expense credit cash. Okay, so for $95. Now we're going to reconcile the bank statement to the company's cash account, and then we'll make any necessary journal entries. Okay, so we're going to prepare the bank reconciliation. Now, there are many different ways to do this. Bank reconciliation is not a formal document. There's no set way to do it. Everyone kind of has their own style. So you'll see many different ways of doing this in the real world. Personally, I like to keep it very simple. So I like to just make it a 3-column approach. So I have a column for the company, and then a space, and then a column for the bank. Now, we start out with the beginning balance. How much does each group think that they have? Right? So, in the beginning, the company thinks they have $1,200, right? But the bank thinks that the company has $742. So that's our beginning balance. All right, now let's go through all of these differences. Now, the definition of difference is that these two sides are not the same. Right? So, in other words, if there is a difference, it means that one side has processed, right? One side has processed and the other has not. Or one side has processed and the other has not. Think about it. Suppose there's a transaction and both sides have processed it. Is there going to be a difference? No. Suppose there's a transaction and both sides have ignored it and have not recorded it yet. Will there be a difference? No. So the only way to be a difference, the only way to have a difference is that one side has recorded and the other side has not recorded. Or one side has recorded and the other side has not, right? That's the only way we have a difference. So with the differences, our job is to figure out who has already recorded that thing and then make sure the other side catches up and they record it. So let's look at the first difference here. We have bank service charges of $15. Okay, who knows about the bank service charges? Who records them first? Well, clearly that's going to be the bank, right? The bank is going to know about those bank service charges first. So the bank has already recorded that $15. It's already part of this 742 here. So who has to catch up and record them now? That would be the company. The company is the one that got surprised and said, oh, there are service charges, and now they have to catch up and get them recorded. So the company has to record those service charges. So what we're going to do is put it on the company side. And of course, those service charges are going to reduce the company's amount of cash. So they're going to be subtracted. Okay, next item on the list is a customer's NSF payment. So in other words, a bounced payment. A customer made a payment of $75 to us and we deposited it. But what we're learning now is that payment bounced. It did not have enough money. It had not sufficient funds. Okay, so who knows first that that payment bounced? That would be the bank. The bank has already included the fact that the $75 wasn't paid. That's already part of the 742. The company is the one who now has to catch up and record that. Okay? So the company has to record that this $75 they thought they had, they don't actually have it. So what they're going to have to do is they're going to have to take that $75 out of their cash records because they did not receive it, right? The payment did not go through. All right, the third thing on the list is outstanding checks. This is where the company wrote a check or made a payment, but the bank hasn't processed it yet. Okay, so who knows about this first? Well, the company knows about it first because the company is the one who made the payment, right? They're the ones who wrote it and processed it and recorded it in their cash system. The bank is the one who doesn't know about it yet. So the bank is going to wait until they receive that request for payment and then they will process it. So when that happens, the bank is going to process, but that will be later. So right now, the company knows all about these outstanding checks, these payments. The bank will process later. And of course, because they're payments, they will decrease the bank account when they happen. Okay, the next item on the list is an EFT, or an electronic insurance payment, right? Maybe this was an automatic payment, maybe it was a one-time payment. Whatever the case, right? It's a difference. Now, who knows about electronic payments first? Always the bank, right? The bank is the one that processes these electronic payments. And until the bank processes that electronic payment, you don't know for sure that it's actually happened. So the bank is the one to process it first, always. That means the company is the one that has to catch up. So the company now has to record the fact that they paid for insurance electronically. So the company is going to take that payment and record it. And of course, since it's a payment, it will decrease their cash. Does it seem like there are a lot of decreases here? Right? Everything seems to be a decrease. That's unfortunately the way most bank accounts work. If you think about it, right, you get deposits, but not as often as you make payments, right? You may get your pay deposit once a month, and then you have to make a whole bunch of payments. You got to pay for your rent, you got to pay for your food, you've got to pay for your utilities, right? So you have a whole bunch of payments that come out, but probably only one or two deposits. So that's typically how bank accounts work. It's not that everything is subtracted, but many more things are subtracted than are added. It is possible to have additions. In this case, I had an insurance payment, but suppose this was a paycheck deposit, right? So if I received a deposit electronically, then this would be an amount that would be added, right? If I had interest that was earned on my bank account, right? The interest earned would add to my bank account. But yeah, most of the things do subtract. Most things do take away from our cash. All right, let's go to the next item, deposits in transit. This is where we made a deposit, but it's on a hold. There's some kind of processing delay. So the company made the deposit, they've recorded it, they know, but the bank is holding off on processing. So the bank is the one that's going to have to catch up here. So the bank is going to now adjust for the deposits in transit. And they are deposits, so these are actually going to increase the bank account, and that will add. Okay, so we've been through all of the differences here, right? And we have set that up. But there's another thing here. In addition, the company accidentally recorded a check written to the electric company for $59 as debit utilities expense, credit cash, $95. Okay, I'm paying my electric bill. This is the correct entry here, right? Debit utilities expense, credit cash. That's correct. What's wrong here is the amount. The amount was for $59 and I wrote 95 in the journal entry. Okay. Now, that kind of thing where like you reverse numbers or you maybe add an extra digit or something, that's a really common mistake to make. I know I personally do that all the time, right? Thank goodness for spell check. But with numbers, right, that doesn't always highlight. And this can happen. I've seen real companies doing this. So there we are, right? We made the journal entry. It's the right entry, but we put in the wrong number. It should have been $59. So we have an error. Now with the differences, I told you, I said, hey, one side has made recorded the difference and the other has not. Let's find the side that hasn't recorded it and have them catch up. Errors don't work that way. Suppose I called up the bank and I said, hey, I made a $1 million error and I added that $1 million to my bank account. So could you make that error too so that we match? All right, does it work that way? Obviously not, right? That's not feasible. So errors are different. The person who made the error will fix it. Okay? So the difference is we're trying to find the side that didn't record and have them catch up. But with an error, the side that made the error will fix it. So who made this error? Well, it was the company. So the company is going to have to fix this error. All right, now, how do we fix an error in accounting? All right, well, it's a two-step process. Imagine that you were writing something, right? Whether it's your homework or maybe you're writing a test, right? Something you're writing by hand. So you are writing down numbers and you're trying to write down $59 and instead you write down 95. And you realize right away, oh, I made a mistake. I put down the wrong number. All right, what do? Well, the first thing you do is you erase that wrong number that you wrote. Or if you're writing with pen, you scratch it out. You remove that wrong number. You erase it. So in accounting, when we make an error, we do the exact same thing. We erase the error. Now, unfortunately, we cannot just say, oh, here's the wrong journal entry, let's delete it. That's not actually allowed by accounting systems. You can imagine the havoc that would happen if somebody went into the system and they were able to randomly delete journal entries, whether by accident or maybe a malicious person trying to do it on purpose. That would really make a mess of the accounting records if people could just willy-nilly delete journal entries. So most accounting systems will not allow you to delete a journal entry. If you want to get rid of an entry because you made it by mistake, you have to do that entry again, but you have to do it backwards. Okay? So the original entry that was made, the wrong entry, was debit utilities expense, credit cash for $95. So what we're going to do is we're going to put that same entry in backwards. Okay? So we are going to debit cash and credit utilities expense for $95. All right, so you see, if we have this entry and this entry, when they meet up in the system, what's going to happen, right? They're going to cancel out, right? This debit here is going to cancel with this credit here, and this debit here is going to cancel with this credit. So this is how we erase a journal entry that is incorrect, right? We can't just delete the entry. We actually have to do the entry again backwards, right? So the entry is erased. So let's go back to the example where you wrote the number down. You wrote down the wrong number, you've erased it. Now what do? Well, you write in the correct number that should have been there all along. All right, so that's what we're going to do here too. Now we are going to write in the journal entry that should have been there all along. So the correct entry that we should have had was debit utilities expense, credit cash for $59. All right, so this is how we correct our error. We remove the wrong entry, and then we put in the correct entry that should have been there all along. What does this mean up here for our bank reconciliation? Well, it means to fix this error, we have to debit or increase cash by $95, and we have to credit or decrease cash by $59. All right, so we're going to increase cash by 95 and decrease by 59, right? That's how we're going to fix our error. All right, now I know some of you are thinking, wait a minute, why do I have to do two different things? The difference here between these is $36. So why can't I just make one adjustment for $36? The answer is you can. You can make one adjustment for $36. That's perfectly acceptable. However, what is the sign? I mean, looking at this, it's pretty clear. Okay, yeah, the difference of $36, I'm going to have to increase cash. I'm going to have to debit. But would you have known that if you just looked at this and said, hey, there's a mistake? Right? Sometimes you can always take the difference easily, the difference between 95 and 59. I know what that is. But determining the sign to fix it can be a little more difficult. So the reason I've taught this to you as a two-step process is because this is a little more foolproof. Right? So if you're at all nervous about, do I have the correct sign? Did I do this the right way? right? This 2 steps, even though it takes a little longer, is a little more foolproof. It'll help make sure that you get the correct direction to fix that error, right? The last thing you want to do is make the error again in the same direction rather than fixing it. So I don't care which way you do it, but I just, if you're a little nervous at all, doing it this 2-step way, erase the entry, right, and then put in the correct number. That is going to help you get the correct total. And that's what's important at the end, that you get the correct amount. Okay. We have now been through everything. We've been through all of the differences, and we've even fixed our error. So the last step is to add up the 2 columns. We're going to add up the 2 sides. Now, if I take these 2 sides and I add them up, I come out with $1,122. And conveniently, the other side comes out with $1,122. Is that coincidence? No, it's not coincidence. That's what tells us that we did this correctly. By having these 2 come out to the same number, it means that I have explained all of the reasons why these original 2 numbers were not the same, right? So why were they different to begin with? Well, it was because of all this stuff. So now we've explained why they are not the same. What if I come to the bottom and these are not the same? What does that mean? It means that either you made a mistake, right? Let's presume you didn't make a mistake. What does it mean? It means that something is missing from this list, that you have not found everything and there's something else on here. Now, suppose you are positive. You have been through everything. You found all the differences here. You found your mistake. You fixed your mistake. There's nothing else but these 2 numbers. Let's say they're still not adding up. Then what could be the problem? Well, if you're positive that you found everything and you fixed it all and it's correct and you still can't make it equal, then there's the possibility of fraud. Right? If somebody came in and committed fraud, if they changed your accounting records, or if they stole cash, right, they are not going to try and leave any traces of that. So that is going to show up as a difference. And that's one of the big reasons that you do the bank reconciliation every month. Because if these 2 numbers are not the same, you want to investigate. Right? If they're not the same, it doesn't for sure mean that there's fraud, but it means there's the possibility of fraud or of some other error that you still haven't found yet. So it's always important to do the bank reconciliation to make sure these add up, because if they don't, you want to investigate. You want to either fix any errors that exist, you want to check or find any more differences that may exist that you're not aware of, and if you've done all that and they're still not the same, you want to find any fraud that is taking place. So that is what's important. The fact that this doesn't add up, that's not a 100% indicator of fraud, but it's an indicator of the possibility of fraud. And of course, if there's even a possibility of fraud, you want to make sure that you investigate. So that is a big reason to do your bank reconciliation. Okay, so what's the correct amount of cash? Let's say this is December 31st. Well, I guess it is in the question. I'm making my balance sheet. What amount am I going to use for cash? Am I going to use 742? Am I going to use 1200? Or am I going to use 1122? Well, the answer is I'm going to use 1122 because this is the correct cash amount. This is the amount of cash that the company has and that the bank has, right? After we've taken into account all of the differences and we've made sure everybody's recording and up to date, and after we've fixed all of our errors, right? So after we've fixed everything, this is the amount of cash we have. So this is the correct cash balance that will go to the balance sheet. All right. Okay, so we did the reconciliation, right? We explained why these two numbers were different, and we've calculated the correct cash balance. There's only one more thing we need to do. How much is in the cash T account right now? Well, it says right in the question, the company has a cash balance of $1,200. This is what's in the cash T account. So what do we have to do to get the company's T account to the correct amount of cash that we want on the balance sheet? We have to record all of these things. So the last thing we do after we finish the bank reconciliation and we know what everything's supposed to be is we make sure that all of these things are recorded in journal entries for the company so that they can all be processed and the cash T account can now be at the correct number, the 1,122. So we have to do journal entries for everything on the company's side. What about the bank side? The bank has some stuff to fix too. Do we have to do the bank's journal entries? No, we're not the bank. The bank will do their own journal entries and they will process these things as they come in, right? So we can be pretty certain that the bank is going to process these payments and process the deposit when their holds expire and when these payments come in, they will do it. So the bank will make their own entries to fix this stuff when they get the information. Now, if the bank made an error, yes, maybe we want to contact them and say, hey, you made an error, can you fix it? And kind of poke them a bit. But the bank is going to go do all their side. What we're concerned about is the company, and the company is only going to fix the stuff on their side. All right, so let's do the company's journal entries. We've already shown the journal entries to fix the error. All right, so let's do the journal entries to fix these other three things. All right, so we'll start with service charges, $15. All right, now clearly cash is decreasing, so that's going to give us a credit to cash. The debit is going to be a bank fees expense. Right, now, bank fees expense, you could call it a service charge expense, you could call it a finance expense, I've even seen miscellaneous expense. The point is it's some kind of expense, right? Something appropriately, and something appropriately described. So some kind of expense. The service charges are a cost to us. So we're going to debit the expense and then credit cash, right? Cash is decreasing. All right, next we have that bounced payment, the NSF payment, right? So we are now decreasing cash because we didn't get the payment that we thought. So a customer sent us money and turns out that payment wasn't valid. So we are again crediting or decreasing cash. What do you think the debit's going to be? Well, what's going to happen to this, right? The customer sent us money and the payment bounced. So what are we going to do? We're going to go right back to the customer and say, hey, your payment bounced. Give us that money. Right? And so it's going back into accounts receivable, right? So we're going to go try to collect that money again from the customer. Now, you may say to yourself, well, wait a minute, if the customer's payment bounced, right? If it was bad, maybe they're having financial trouble. Maybe they're not actually going to be able to pay us. And that is a legitimate concern. That's actually a topic we're going to talk about in another couple of lectures. We're going to talk about what happens when we have accounts receivable and they're legitimate receivables, but we can't collect the money. All right, so that is a topic that's coming up. For now, we'll just say, hey, it's going back in accounts receivable. We're going to try to collect it again. All right, so last one here is the electronic insurance payment. Clearly, we're going to credit cash here, right? And decrease cash. But we do need a debit, of course. So if it's an insurance payment, what's the debit going to be? Well, the obvious answer is that the debit has to be insurance expense, right? Because we're paying for insurance here. But it may not be insurance expense. If we're paying for insurance for last month, it's insurance expense because we've used it. But what if we're paying for insurance for next month instead? Well, then it wouldn't be insurance expense. then it would be a prepaid insurance. That's a possibility too. There's not enough information in the question to know, right? We just know there was a payment. We don't know if it was before or after the fact. So it just depends on the timing of the payment versus the service, right? Have we already used the insurance? Then it's expense. Or is it insurance for the future? Then it's prepaid insurance and it's an asset. So it's one of those two. Okay. One last little thing here. You may notice that with my journal entries, I did not use the little DRs and CRs. I didn't put the little denotations for debit and credit. Now, doing that, putting the little DRs and CRs, that's essentially a learning technique. When you're starting to learn how to do journal entries and you're getting used to it, right? You put down the little DRs and CRs because it helps you, and it helps you structure the entry. But, as things go on, it's not always something that real accountants do. I mentioned before that real accountants can be lazy. We often do not put in those DRs and CRs. So if I were just talking with another accountant and we were scribbling out some journal entries, we do it exactly like this. We wouldn't bother with the DRs and CRs. We just say, look, the debits come first and the credits are second and indented. And that would be it. So you can still continue to use the DRs and CRs. I have no problem with that. But I am going to stop using them because I want you to get used to seeing the journal entries without those notes. Because this is how a real accountant would write out journal entries in the business world. So I just want you to get used to that denotation. And so that's why that's there. All right, let's do one more quick example for a bank reconciliation. All right, example 2. Gord Inc.'s cash T account had a balance of $2,800 at December 31st. However, Gord's bank statement showed a balance of $3,100. The bank statement included service charges of $20, right? $15 of interest revenue, and a $500 EFT collection from a customer, none of which was reflected in Gord's T account. Gord's records showed checks of $200 and deposits of $395 that were not on the bank statement. All right, so let's prepare their bank reconciliation. Okay. So we start here with a column for the company and a column for the bank with some space between. Okay, first thing here is their opening balances. We know that Gord's cash T account had $2,800, but the bank statement shows $3,100. So that's where both companies are going to start out. Okay, next thing. The bank statement included service charges of $20. Okay, now the bank knows about the service charges first, so the company is the one that has to catch up. The company is going to subtract those service charges from their account. Next, there was $15 of interest revenue. All right, so if we're earning interest on our bank account, the bank is the one that knows about it first, right? The bank is the one that calculates the interest and then first records it to the account. After that, the company learns about the interest and records it. So that's what they're doing now. They've learned about the fact that there's interest revenue and they're going to record it. So the company was going to add that interest revenue to their bank account number. All right, and then lastly, the bank statement showed a $500 EFT collection from a customer. So one of our customers paid electronically, right? They made an electronic payment, maybe they did an e-check to us. So we've collected money from a customer. Now, an EFT, an electronic transaction, the bank is always the one processing that first. So it's the company that's going to have to now process that. But it's a collection. So if we're collecting from the customer, that's actually adding to our cash balance, and we're going to add that $500 to our cash amount. So the company is going to add the $500. All right, now, the other way that we knew that all these things were company stuff is because they're things on the bank statement, right, none of which are reflected in the T account. So that's a really good hint that the T account has to be updated to put them in. Now, the next items are from Gord's records. So Gord shows checks of $200 that are not on the bank statement. So that means Gord's recorded this, but the bank has to catch up. So what do we call that when we have checks or payments that we've made and the bank hasn't processed? Those are outstanding checks. So the bank is the one that has to process those outstanding checks, those payments, and once those are processed, that will decrease the company's cash, right? Because they're payments. Gord's records also show deposits of $395 that are not on the bank statement. So again, the bank is the one who's going to have to process those deposits. And when they do, it's actually going to increase our bank account number. All right, so these are all of the differences that were found in this situation. So since that's all we know about, we're going to take those and we are going to add them up and get a total of $3,295 on each side. And fortunately, they're the same. That means that we have found all the differences and we have correctly processed them. Okay, now there's a part B to this question. So part B says, how much will Gord report for cash on the December 31st balance sheet? Well, the answer to that is it's going to be the $32.95, right? Because that's the correct amount of cash that the company has. All right, now the question does not actually ask for the journal entries, but very quickly, I just wanted to do them. So the company is going to have to make journal entries for their side. So first, they're going to have to make journal entries for the service charges of $20. That's going to decrease cash and debit a bank fee expense. Secondly, they're going to have to record their interest revenue. All right, in this case, cash is going up, so cash is going to be debited, and the credit is interest revenue, right? Revenue is credit. So we're going to debit cash and credit interest revenue. All right, and then lastly here, we have this collection from a customer. All right, cash is increasing, so we're going to debit cash. And since it's a collection from a customer, that customer owed us money, right? So the credit, the decrease is going to accounts receivable. Right? So we're going to set this up as accounts receivable. All right, so there we go. Okay. So if we were doing the journal entries, that's what they would look like. Now, a bank reconciliation is an example of an internal control. So what is an internal control? Okay, and internal controls are a system of rules and processes in a company that are designed to safeguard assets and accounting records. So internal controls are things that we do or systems that we set up to protect our assets and protect our accounting data. Now, cash is the most vulnerable asset that a company has. Cash is the asset that's most usable, that's most difficult to trace, and that everybody wants, right? So cash is always something that has to be especially protected. So let's say that somebody is stealing cash from the company. There's actually a fancy name for that. It's called defalcation. Right? Make sure you put the L in there, defalcation. So that means that your company who is responsible for the company's cash is stealing their cash. Right? So that's just one of those fancy terms that detectives like to use. Okay, so How do we protect our cash? How do we prevent somebody, an employee or anybody else, from stealing it? Well, one of the best ways to do that is by using the bank reconciliation, because the bank reconciliation forces us to look at cash every single month. And so we're looking at that cash and we're saying, hey, does it add up? And of course, if it doesn't, we're going to investigate, right? So the bank reconciliation very quickly alerts us if there are any issues. So that's why a bank reconciliation is an internal control. It's one of the tools we use to help make sure that our cash amounts are correct. Okay, but what if the person who's stealing the cash is the same person who's preparing the bank reconciliation? Well, then we're going to have a problem, right? Because if the person who's stealing the cash is also doing the bank reconciliation, then they can obviously doctor it up, right? They could change things and fudge it to make it look like the bank reconciliation is correct, and the company is still clueless. So that's obviously a problem as well. So another big element of internal control is something called separation of duties. And this is super important for a company of any significant size. Okay? So separation of duties says that employees should be assigned different tasks. So most importantly, all of these different areas should be handled by different people. So asset handling, that means physically dealing with the assets, including cash. Record keeping, the people who do the actual journal entries or perhaps prepare the bank reconciliation, who actually do the accounting. And transaction approval, right? So who is able to approve of things happening, of spending money, of withdrawing money from the bank? All of these should be handled by different people. So let's imagine, for example, that a customer goes into a company and they make a payment on their account. So somebody in, at a desk at the payment office or somebody in the mailroom, they receive that cash payment. Then they pass that payment on to another department where they will now record that payment being received and do the journal entry for it and update the customer account, right? So the person who received the cash is different from the person who's actually updating the records. Okay. Then that department will pass over the cash to another person who will actually take that money to the bank and deposit it, right? Who has the ability to go do that. So now we have 3 different people doing this. Now, could we still have an example here where people are stealing cash? Yeah, we could, right? That could definitely still happen. But that's a lot less likely because now 2 or probably all 3 of these people would have to collude and they'd have to work together. So now in order for there to be fraud, you have to have multiple people working on it, and that makes it much more difficult to commit. So it's a lot less likely to happen or more likely to fall apart if you have multiple people who are in on it. So separation of duties isn't a be-all and end-all. It's not going to end everything, but it does make it much more difficult for fraud to occur. And that's why it's a very useful tool. Okay. Now, I've talked about this in terms of cash receipts. It's also very useful for cash payments. One common fraud, which has been committed many, many times, is for people to create false payees. Okay. So let's say I work for a company and I'm in charge of paying the bills. I set up in the accounting system a company called, ABC Inc. But ABC Inc. is actually owned by me. Or maybe it's owned by my brother or my friend. Regardless, I put this company into the system. And then I put an order in the system and I say, hey, we're ordering a bunch of stuff from ABC Inc. And, they sent us an invoice. We've got to pay ABC Inc. But there was nothing ever received. Nothing was ever done. I'm just making a payment to this other company. All right, so I could get money out of the company that way. It would look like legitimate payments, but they're not legitimate. They were for nothing, right? The person is stealing. So how do we prevent that? Well, let's say that I want to put a new company in the system. We should have one person who approves all of the new vendors, all of the new payees who go into the system. Let's say that I want to buy something from a company, right? We need a person who approves the fact that I want to buy this and that that's okay, right? Then when that item arrives, right, it has to arrive at the shipping dock or the warehouse or something. So there should be a different person who receives the item when it arrives, right, and then can verify and maybe sign a bill of lading or something that says, yes, we received this merchandise, right, or we received this service, right? So somebody else. And then another person who puts that bill into the system and eventually makes sure the bill gets paid, right? So by splitting out these areas, we make it much more difficult to commit that fraud. It doesn't just have to be with merchandise either. Another very common fraud is to create false employees. So I create a new employee, Joe Smith. And somehow, Joe Smith's bank account, I can access Joe Smith's bank account. And he has a strange social security number, but he's in the system and he's an employee and he's making $50,000 a year. Okay, so Joe Smith is not a real person. I put a fake person into the payroll system. I set them up with a paycheck and I'm going to be collecting that paycheck. All right, so clearly that is a weird fraud, but it does happen, and it goes on. So how do we prevent it? Well, we have one group of people who's in charge of interviewing and approving the hire of new employees. And once those new employees are hired, we have a separate HR department who is going to put all that new employees' information into the system and approve them. Right? And then another person who's actually going to process the payroll and get that done, right? And of course, another person who's in charge of making sure that that cash actually gets paid out to employees, right? So by splitting up the tasks, again, we're making it much less likely that fraud will occur because it's more difficult when people have to share the task. I tell you, when I was working as an auditor, one of the funniest things I've ever done, and I didn't even think so at the time, but later looking back, I thought it was funny. I was working at this company and as an auditor, and I went down to the factory floor, and there are these guys there working on the line, and I went up to one of them and I said, "Excuse me, sir, are you Joe Smith?" And he turned around and he said, "Yes, yes, I am. What can I do for you?" And I said, "That's it. Thank you." And I walked away. Now, of course, Joe Smith was super confused, right? What the heck was that all about? But as an auditor, what was I doing? I was doing a test to make sure that the employees listed on the records actually existed. So I took a random sampling of employees and I went around the office and the building and I found those people and I made sure they were real people, right? So I made sure that that fraud wasn't happening and that that system was working correctly. So it seemed a little strange to the guy at the time, but there was an audit purpose behind it. Now, there's another type of scheme that can happen, and it happens far more often than companies like to admit, something called a lapping scheme. So let me describe how a lapping scheme works. So let's say that I am in charge of receiving cash payments from customers. Right? Maybe I'm a clerk and I work at a desk where people come up and make payments. Maybe I work in a mailroom where people send in their payments. All right, so customer comes in, makes a payment. They're paying $1,000 on their account. And I have this $1,000 in my hand. And I think to myself, I could use $1,000. And instead of putting that $1,000 into the company's cash drawer or sending it up to the appropriate department, I put it in my own pocket. So I've taken the $1,000. All right, clearly that's fraud, that's a crime. But what's wrong with my crime? What's going to happen? It's going to be discovered pretty easily because eventually, right, the customer's going to say, "Hey, wait a minute, you're still sending me bills for this $1,000 and I've paid it already." Right? And then there's going to be an investigation and I'll be found out. So, I mean, I could commit that crime, but I'd be found out pretty quickly. So I have to cover it up. All right, so what am I going to do? Customer number two comes in and they make a payment on their account. And I take customer number two's money and I send that up to the accounting department and I say, hey, this is for customer number one. All right, well, that might work for a little bit, but then eventually customer two will get wise. So what will I do? Well, I'll take customer three's money and use that to apply against customer two. Okay? This is why it's called a lapping scheme. Think about like the ocean and waves coming in on the shore. So a wave comes in and it smooths out the sand, and then the next wave comes in over it and overlaps, right? So we have all these overlapping waves coming in. And I use the one to pay off the previous one. And I'm manipulating the money around to hide the fact that some of it is missing. Now, this sounds like it's not a big deal, right? It's a small amount of money, but people have perfected these kinds of lapping schemes, and there have been millions of dollars that have been stolen from companies by people who are doing this and moving money around in the accounting records to hide the fact that it was missing. There have been situations where you'll get a little old lady who's retiring from the company after 30 years of employment, and she was such a great employee and everyone loved her and she always came in with cookies. People thought she was great. And a couple months after she's gone, the company realizes millions of dollars are missing, and by then the lady's off living in Mexico. um, it sounds kind of silly, like a bad movie, but those kinds of things have happened. People have been very good at doing these lapping schemes and hiding what they're doing. Now, what's the problem with this? Well, the person who's doing the lapping scheme has to have their own complicated set of records. They need to know which payments have come in from which actual people and how they have applied that money to the other people. So they need to know what's going on and they need to be in control of it. Let's say they missed a day of work and somebody else had to take over their job. That person is going to mess it all up because that person's going to receive money and they're going to put it in the wrong account, wrong in quotation marks, of course, and they're going to start toppling down this person's lapping scheme. So the problem with the lapping scheme is that the person who's running it can never miss a day of work, ever, ever. They can't take a sick day, they can't take a vacation day, because if somebody else looks at their job and what they're doing, everything is going to fall apart. It's all going to come crashing down. So one of the things that auditors do is they actually will take a look at all the employees and their vacation time, and they'll say, hey, when was the last time this person took a vacation? Now, if somebody is not taking a vacation, that doesn't mean that they're committing fraud. It just means there's a possibility. So as an auditor, what I used to do is I'd go through and I'd see, hey, these are all the people who haven't taken a vacation. And if they hadn't yet taken their vacation, we just kind of send a notice to the CEO and say, hey, look, these people haven't had their vacation. They deserve it. Make sure they take their vacation. Right? So we're not pointing fingers at anyone, but we're trying to make sure that they get their vacation time, where if they're a legitimate employee, that's a good thing, right? So that's another thing that happens. So the sum of all this is that there are all kinds of ways to manipulate accounting records and steal assets. And cash is the most vulnerable asset. But by having a good system of internal controls, you can help protect cash and protect your accounting records. So two big components of that for protecting cash are the bank reconciliation and separation of duties, right? So those are things that we can do to help protect our cash. Okay, so for homework, I'd like you to look in chapter 3 at questions 1, 2, and 3, and that will be due on Tuesday. And then next class, we're going to start talking about those accounts receivable and what happens if we can't collect all of the accounts receivable. So that will be next time. Until then, stay healthy.